following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
All right, and that music means it's time once again for Volatility Views, the premier radio program for volatility traders. My name is Mark Longo from the OptionsInsider.com, as well as the ever-expanding Options Insider Radio Network, and I am joined on the old Volatility Views panel today by none other than one Don Schlesinger of Volex fame. Don, welcome back to the show, sir.
Thank you. Always a pleasure to be here. Looking forward to another lively discussion today. Have a few topics that I hope will be of interest to our listeners. And just coming in from a little dusting of snow here. We looked out today and said, what's this stuff? Haven't seen that in a long time. Keep forgetting it's still February.
I could also say Don Schlesinger of blackjack fame, revered by legions of blackjack players around the world for his wit and wisdom and knowledge, and indeed lengthy tomes on the sport and the art of blackjack. But we'll keep it to the volatility for the purposes of this show.
Fair enough.
All right, and listeners will also be joined in process by one Mark Sebastian from OptionPit.com. But now it's time to dive right into our volatility review.
It's time for the Volatility Review.
All right, and it's time once again for the Volatility Review. This is, of course, the portion of the show where we break down the week's worth of volatility action, and we're going to kick things off this week doing it a little bit backwards. We usually start with the old S&P volatility. We're going to mix it up somewhat this week and dive into the world of the euro, because if you've been paying attention to any of the headlines this week, it's been euro, 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 Greece, Greece, Greece. That's pretty much been dominating the headlines all week. So the euro has been an interesting product to watch over the past week, and we have our Euro devotee here on the show with us, our Euro expert, none other than Don Schlesinger, to break down the week's worth of action in the Euro. So Don, what were we watching here in Euroland over the past week?
It looks like I got this one right for the past week. Listeners might remember that we looked at about 1066 settlement on our front month VolContract, and that looked a little bit high to me, given that we were, about a week and a half into the calculation of the realized volatility period, and we were seeing single digits there. So we talked a little bit about that potential disconnect between the volatility yet to come and the volatility that had been measured. And I said I thought we'd be going lower. We went substantially lower. We actually sitting at 9.38 for last night's settlement, and we're now a little bit more than halfway through the 24-day realized volatility period for the March contract. And I think the interesting point here is, there's been tremendous news out of Europe. It's been ongoing, but we often define volatility as uncertainty. We always talk about volatility is, when we're not sure what's going to happen. the more an issue gets resolved and the more we know about something, it's just like when you're speculating on earnings and then, of course, they come out, or some event is going to take place in the future and then you finally get to the date when it happens. Well, there was news out of Europe and there was a kind of resolution there. And the result is that you now have volatility that is kind of entrenched in single digits at the moment for the euro. And the other part that's interesting about that is that this is not necessarily uncommon. We may have seen 10, 11, 12, 13 volatility for the euro when everything was going on in the past year or so. But this is when it's nice to resort to the VolCones and to take a look at historically what various percentiles are. And I've just pulled up on my screen about the last 5 years. In fact, why don't I even go back 10 and use data? And the median volatility for the euro over the last 10 years is 9.36. Well, that's pretty amazing.
That's
told
amazing.
you the close was 9.38 last night. So what you're really seeing is completely normal volatility from a historical point of view for the euro at the moment. Going back in time, what people look at and say, gee, this looks awfully low, is, well, it's low compared to what had been going on. But as we'll talk about a little bit later, or perhaps in just a little while, about the equity indices, it's the same kind of comment. What everybody is calling, my goodness, that's low, from a historical point of view, might be somewhat otherwise. So that's what's going on with the euro right now. And
I know you guys love your VolCones over there, and I could certainly see why. Yet again today, another example of why VolCones can be so useful, and indeed, as you guys say over there, quite tasty and delicious as well in this case, because it gives you a good perspective, and it is interesting too when you think of the euro. I mean, these past few months, past few quarters, when the eurozone has been quote unquote imploding over there, it's been the primary driver of vol across the board for a lot of different areas. Euro, of course, being the main one of those. But now that's, I suppose you can say, somewhat settled, at least for the near term, you kind of have to wonder what drivers there will be going forward for Eurovol, at least for the near term. We might be stuck in this quote unquote normal range here for quite a while, unless yet another surprise country in the Eurozone decides to implode, which, given what we've seen over the past few years, is not exactly a very wild proposition. But interesting to watch nonetheless exactly where, and you think with all the things that happened with the euro over the past 6 months or so, that the euro it got high, the vol got high out there, but perhaps not as high as you might expect given everything and the dire nature of what was unfolding over there. So it gives you a good handle on really what the true nature and the true range of euro vol can be. We didn't see the VIX-like kind of crazy panic like we saw back in 07, 08 with the VIX when it shot up to plus 80, and that ridiculously over-proportional response. We saw a sharp rise in Eurovol, but I don't think it was, I don't know, would you categorize it as perhaps extreme as what we saw in the VIX back in the meltdown?
Well, one of the things that you use to sort of measure just how crazy does something get is actually what we often refer to as the volatility of volatility. How much did this volatility move around? Not just what was the apex, but what kind of fluctuations did we see in it? And I'm trying to pull that chart up now. When we take a look at, let's say, the last year in Eurovol, you had volatility of volatility reach as high as about 100, I'm looking at about 130 or so. And as a matter of fact, that is pretty high because going back for, let's say, the same 5 or 10 year period that I studied before, the average 1 month volatility of the volatility of the euro was about 78 or so. So you've got this 21-day volatility, and then you've got a measure of how much that moves around, the vol of vol. So historically, for 10 years, that volatility's been about 78, but we managed to see it, get up into the 120 range when all the craziness was going on. So obviously that is an indication. And of course, for the actual volatility itself, that hit a high of about 15 or so. But it had been higher. It had been all the way up into the 20s briefly in late 2008, 2009. So you're right in terms of the absolute levels that Eurovol reached. We never really crossed much above 15, even with all that was going on in Europe.
Yeah, so it definitely had some impressive vol of vol. I think, but the net movements, of course, we've discussed many times on the show how the net and the vol of vol are usually not synonymous
right.
in what they generate. In fact, we had that discussion just last week. And speaking of vol and vol, we might have an interesting question about that coming up in our mailbag as well. So perhaps we'll table the rest of our vol of vol discussion for now. But of course, Don, we are paving the way for the launch of yet another new product in the old VolContract suite. And that, of course, is the upcoming Nasdaq VolContracts and the myriad products therein, the options, the futures, the options on the ETNs, ETFs, or whatever unfolds coming that way. So it seems to make sense now to also incorporate a vol review here on the Nasdaq as well going forward. So I think we're going to start doing that. We touched on it a little bit last week, and I think this week will be a good time to really start incorporating that into the show going forward. And I think it's fun to talk about Nasdaq vol, just because I often refer to it as kind of like the S&P's overly dramatic sibling. It's just whatever you see in the S&P sometimes, you just see it amplified times 1.5 or perhaps 2 sometimes in the Nasdaq. And that's for a number of reasons. A lot of that is because Nasdaq is still a very tech-heavy index, and those names tend to have a lot of volatility and volatility of volatility, so they tend to move the index. Yeah, today is one of the few days when both the S&P, as we're recording right now, and the Nasdaq are both up 0.4%, so they're in lockstep. Yesterday, I think Nasdaq was up about twice as much as the S&P, so has been some the vol of vol in Nasdaq has been intriguing. So what were you watching over the past week in terms of Nasdaq vol? Have we seen the same degree of the sell-off in Nasdaq vol that we've seen in S&P/VIX over the past week or so?
We actually have, and this is really quite dramatic. I can't say that I've been a student of Nasdaq volatility over the years to the same degree that I have of the S&P, but I have, with the coming of our vol contracts in Nasdaq, hopefully very shortly, been starting to bone up on historical data. And this is really an extremely unusual period, as we've already commented, for SPX or S&P, also for Nasdaq. We are at levels now that truly, for realized or historical volatility, the actual movement of the index, are extremely low from a historical standpoint. And not only that, but since this is a review of the past week, it's absolutely dead in the water. It's a remarkable graph to look at, and I would urge our listeners to go to the volex.us website, go to the pull-down menu where it says data, and simply look at the Volex indices, pull up equity indices, pull up the Nasdaq or the S&P or the index of your choice, and then you have a time period that you can look back. It can be as short as 10 days or a month or 3 months. If you look at the shortest window, the line is absolutely horizontal, just as I often joke about, it looks like the patient died. And if you ask me what was the trailing 1 month historical volatility of Nasdaq, and you say, well, give it to me for today or 5 days ago or 10 days ago, it's exactly the same thing within decimal points, all around the 10 3/4 range or so. And then just to put that in perspective, yet again, if we look at our vol cones, which are, historically crunching all the data as to, what you can call normal. Well, if I go back, let's say 10 years worth of data or so, and I ask it what's normal for 1 month or 21-day historical volatility, I find that 90% of the time, that number is higher than 12.3. And we're sitting at 10 and 3/4 right now. So, we don't have the fine gradations. Maybe it's 92% or 93%. But the vast majority of the time, if you studied 1 month volatility of Nasdaq going back 10, 20 years, you would find it to be higher than it is right now.
So Don, I know given your predilection for selling or not selling vol, I wouldn't insult you by saying this might be a quote-unquote buying opportunity for you in Nasdaq vol, but would it be safe to say that you would be not selling Nasdaq vol here?
Yes,
okay.
I would have to say that at this point, it would be safe to say that this does not look to me like a very good time to be selling. Now, that said, and of course, when Mark Sebastian may join us, we can talk all about VIX futures and, the potential disconnect between the actual product that you can trade and the index itself, the VIX index, which you can't trade. That said, we still have to consider that we're talking about realized volatility here, historical, and what the market is actually doing. And then if we're talking about trying to trade volatility, we're talking about, products that allow us to buy or sell something that settles to some form of volatility. There can sometimes be a disconnect there. So if you're going to tell me that, we don't have volatility futures yet for Nasdaq, we hope to soon, but we've got VIX, futures, and if they're still hanging around in the 20 range or so, and you say to me, what's the story there? Well, that's a whole different level from where we are. People aren't willing to sell 10; they're willing to sell 20, and we've looked at VIX over the past month or so, and when the index itself was at 20, people were saying, uh-oh, beware, careful, caution. Then it was 19, then it was 18, then it was 17. And if I've got my numbers here correct, it looks like we're sitting at about 16.5 on the actual VIX calculation on the index itself.
Yep, we're trading right now in the VIX cash at 16.54 right now in midday Chicago time here on Friday when we record this.
So, not to be sarcastic, but, where are all those people who looked at VIX at 20 and said, raise the red flag, this is really bottoming out here, and this is telling us to be cautious. And, then a week went by and it was 19, then another week went by and it was 18, then the third week in February went by and it was 17, and now we're working on the fourth week in February and we're 16.5, and who knows if next week when we speak, it won't be 16. So, I'm not saying that doesn't mean the market could drop, 200 Dow points tomorrow or Monday. But yet again, it's sort of like the stopped clock is right twice a day theory. All these people who are telling you how afraid you ought to be for the past month, I'm sure that eventually they're going to be right. But when they do come out from under their rocks and say, you see, I told you so, we might be in April. And you might have been buying this market since Christmas and having a heck of a run-up in January and February, and there's nobody to say that it won't go on through March and April and into the second quarter and into the springtime.
Exactly.
So,
and once we get into May, that's usually the traditional time when the index sells off and just kind of settles into its rut, as it were, for the whole summer anyway. The old adage, of course, on the floor of sell in May and go away, because the paper goes away, the vol goes away, it becomes kind of a very stagnant place. The old summer doldrums, they used to call them on the floor. But so if we carry these levels into that period, we could be looking at a substantially long period of time where we're hovering in what people in the current frame of reference of volatility think of as low. Even though if you look at the long term, you're right. This is relatively elevated vol for the S&P overall. And it is funny to see how people always try to chime on how these. It's, for example, we talked about a couple quarters ago, back during the S&P downgrade time and all that kind of kerfuffle that unfolded after that point, about people were heavily shorting the VIX at that point, saying it had to come in, had to come in, it had to come in. Of course, it didn't for many, many months. And a lot of people who continued to roll their short positions ended up getting burned pretty heavily on this. And now we have the same scenario. A lot of people said, myself included, I thought it was going to settle in around the 23 to 25 level, and here we are nearly 10 handles below that. So I was off as well on my predictions here, but a lot of people who have been holding to their guns and saying, "Oh, VIX is low now at this low 20s level. I should scoop up some vol." And yet, if you looked at the realized, of course, VIX still had a way to go. And you're right, there is a discrepancy right now in the front month and near-term VIX futures versus the VIX cash. Since Mark Sebastian isn't here, I'll put on my Mark Sebastian hat. I suppose that means I have to get very crazy and say some outlandish things right now. Maybe I'll have to insult you a little bit too, Don, and perhaps if we had a guest, I would insult them too. But no, I'm just teasing poor Mark because he's not here to defend himself. But of course, yes, there is quite a surprising discrepancy between the front month VIX futures. We have March rolling into April, as well as with the VIX cash. There still is a substantial premium going on in the VIX futures, and so you have that eternal question of which is right. Are the VIX futures going to eventually settle down to where the VIX cash is trading, or is the VIX cash going to bubble and froth its way up to some mid-tier level between the two, and they're going to settle out there? And it seems to be so far, if you were betting on the VIX futures coming in, you've been betting on the right side of the fence. But also it's interesting too, because a lot of people typically in these types of scenarios where you're looking at the VIX coming in quite a bit, quite aggressively. People have been playing it short quite aggressively of late, trying to capture those last few points of premium between implied and realized vol in the VIX. But also, because the VIX is getting towards the lower end of its range, there is a possibility for that unknown to rear its ugly head. Another country in the Eurozone could implode, or some other crazy event could happen that could send the VIX spiraling up northward again. So a lot of people tend to hedge if they're coming in, picking up, let's say, downside put spreads in the VIX, that they're also looking to hedge with some upside, maybe some upside calls or upside verticals to protect themselves. And the fact that there's such a disparity now between the VIX futures and the VIX cash means that if you're doing that, you're still paying a reasonably high premium for that upside protection. So a lot of people probably aren't doing that to the degree that they probably should be, given everything that's unfolding in the current marketplace. And I hear the sounds of frenzied clicking and frenzied typing. That could only mean one thing. We are joined by one Mark Sebastian from optionpit.com. And Mark, you missed it. I was just wearing my Mark Sebastian hat, so I was being very crazy, very somewhat inappropriate. Made a lot of 80s references, and
really?
It was very good. I made some uncomfortable analogies. I think I did a good job of channeling you to the fullest extent.
Oh, well, thank you. I appreciate you carrying on the torch when I'm indisposed.
Well, we're just wrapping up the old VIX review. Anything you want to toss in here about what you've been watching?
Did we guys talk about T-VIX at all and what kind of happened with that ETN?
We haven't had a chance, but you mentioned that in the show notes, and it was an interesting week for T-VIX. Of course, if you don't know what T-VIX is, it's that double 2x ETN that tracks the VIX, and it got halted this week. It got halted a couple days ago.
Yeah.
It wasn't any sort of regulators who came in and said you have to halt this. It was the company saying there's too many assets in this thing. We have to reapportion it a little bit.
The company, State Street, basically. Yeah, State Street, I believe. The interesting thing is that they basically said we're not making any more creation units. They had topped out the fund's limit on the amount of creation units they can make. So what has come as a result of that is that now T-VIX, which should basically have an NAV and should move at twice VXX, is trading at a $2.66 premium to its NAV.
You have to love these ETNs and stuff. It's fantastic.
It is trading legitimately at a $2.60 premium to its NAV because there's demand for it and there's no creation units. So the interesting trade is you can do it in VIX futures, you can do it in VXX if you want, you can do it in XIV, whatever. Can you create a portfolio that mimics T-VIX and then sell T-VIX and then essentially be able to wait out the regulatory approval for more creation units, etc.?
I mean, there has to be a way to capture that premium, and this is not a permanent thing. They are going to create more shares down the road sometime. So if you can,
you would think
you can survive that holding period, you're doing good.
Don't know that for certain.
That would be a surprising thing if they close the doors on this. Thing has been an explosive success for them, a runaway success.
I know, but they have to have a lot of assets. There's certainly some note risk on their end. This is actually relatively unique. There's a couple of conspiracy theories floating out there that somebody was trying to get them to do this, to kind of corner the market out. And I don't know why, but it's definitely it's really interesting what's going on with this product right now.
If you look at it, they had about $500,000 in assets just a couple of weeks ago. They've increased 40% over the past 2 weeks. They're trading almost $700 million now. If you compare that to the number one VIX product, or the VIX license product, it's VXX. That had just over $1 billion in access. So this T-VIX has almost caught up to VXX in popularity just in the past 2 weeks. So something's going on there. There's been an explosion of volume. Where that's coming from, whether the Hunt brothers are diving into T-VIX, I don't know. But I wouldn't be surprised.
Yeah, there's something really interesting going on, and I'm not 100% certain what it is, but it's certainly not something I completely trust, and it's a little nefarious if you ask me.
It's an interesting spread, and I know where you're coming from a market maker perspective to try to capture that premium, because it does seem so ephemeral, and it does seem so ridiculous to have that premium built into the NAV like that. But you're right, if there is someone pulling the strings behind the scenes, you don't know what's going on with that premium, or how long it's going to last, or if it could even expand if they keep bidding this thing up out of control. So it is an interesting one, I think, to mull. And might be a good assignment maybe for next week. We'll mull over some ways to replicate that. Of course, by next week it could be all done. But and it could be.
Yeah, I mean, it's really interesting, but it's extremely hard to borrow now. But at the same time, there's major demand to own it. I mean, is somebody that wants a vol hedge trying to corner the market so they can loan it out and cover their nut on the actual? You may be actually, with the NAV inflated like this, be able to cover your nut on loaning out the shares.
I love your technical terms that you throw around here on the show, sir. But yeah, and I know you're a big fan of covering your float and your loans. That's a big thing for you. I know you were talking about parking futures back in the day. It's a big focus for you, and one of your personal crusades. But an interesting topic. I think we'll have to watch this one, and that's something I want to mull over myself a little bit too. Is how would you accurately replicate that T-VIX? I'd really have to dig into the quote-unquote T-VIX prospectus and see exactly what they're doing, and then see what you could. Because all these things, you never know. There's some weird hiccup in the formula somewhere where it's not exactly 2x, and it's not exactly doing what you think it would, and maybe they're doing some certain percent out of the money or something else like that you'd have to replicate, and all these interesting things that go into these licensed products. But definitely one to keep in mind if you're thinking about trading these ETNs and ETFs off VIX or anything else, that these kind of things can happen, and you should plan for it. If you were heavily shorting T-VIX, you're not too happy right now. So interesting stuff going on right here in good old VIX land. And that is going to do it for our volatility review. And now we're going to dive right into our volatility viewpoint.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
All right, and that festive tropical theme, and I know a lot of us wish we were in the tropics right now with snow gracing our doorsteps here. But yes, that festive tropical theme means it's time once again for the old volatility viewpoint. This is where Don, Mark, and myself sit back and pontificate on some of the loftier aspects of volatility. And Don pointed out to me before the show that we are approaching, coming up in mid-March, our 1-year anniversary for the Volatility Views program.
Is that right?
It's insane. It's hard to wrap my head around. It feels like it was
just yesterday that the soothing sound of Don's voice became a regular event in everybody's weekly lives.
And all of our lives are that much richer for it. I can certainly safely say that.
Mark, you should fly you and me to New York, and we could do a live show.
There we go. Or yeah, maybe we'll do something like that. Or maybe we'll fly Don in here and we'll do some sort of spectacular.
Oh, we'll do a bit. Oh, that'd be great.
Dancing bears, the whole 9 yards.
Yeah, an option insider spectacular. So.
Oh wait, we're having one next week, so right? We can just incorporate it into that.
Yeah, your anniversary thing's coming up next week, right?
Yes. That's
big
gonna be fun. Options Insider 5-year spectacular is coming up.
That is awesome. Well, my goal is to drink you out of house and home when I'm at your party.
I just signed off on the deluxe bar package today, so you may have the opportunity to do that. I probably didn't think twice. At least Don's not coming, because I know I'm safe in that regard.
That's true.
He has very exotic taste. He'll be asking for the 20-year scotch.
They call him Don Two Livers Schlesinger because he drinks so much.
Yeah, safe in any event from that.
But of course, we are coming up on our 1-year anniversary. So Don made a good suggestion. He thought it'd be a good time to touch again on some points we touched on when we first launched the show, kind of going over for our new listeners, and there are a legion of them out there, about some of the nuts and bolts of these contracts we're talking about all the time, the VolContracts. And we toss that around on this show all the time, that term, assuming our listeners have a passing familiarity with them. But in truth, a lot of our listeners are new and maybe don't understand the basics of what these contracts are and how they kind of compare to what's out there right now. So I think it's a good time to do a brief overview of those contracts yet again. So Don, take it away, sir.
What I'd like everybody to know is that what we've created in a VolContract futures is something that's going to deliver at its expiration the actual market or realized volatility of the underlying asset in question. And so different from an implied volatility product, which is constantly looking forward and forecasting or attempting to put an implied volatility spin on the contract, ours actually settles to a formula and actually calculates the daily returns and plugs them into a classical standard deviation formula and delivers to the holder of the contract the actual market volatility, the volatility we were speaking about at the beginning of the show, the historical day-to-day closing volatility of the underlying asset. And we trade these contracts and list them prior to that calculation period. So if we were going to want to have delivered for us March realized volatility on the Nasdaq, we would start the clock, if you will, the calculation period to cover roughly the same March period as options so that there could be a hedge and that they would expire at the same time as the VolContract futures. But we would list that contract several months prior to March, and it would trade on the expectation that one day it will settle and expire to the March realized volatility. And so what our listeners and potential future traders need to understand is that once that calculation period begins, we start to log these day-to-day points that represent the squared returns or the continuously compounded returns of the underlying asset. And there's a growing portion from day to day that represents the already realized or historical volatility. So that's the history. On the other hand, there's a portion that remains that, if you will, is the mystery, a kind of coined a phrase that the price during the realized volatility period is a little bit of a blend of history and mystery. And so what's left is the volatility yet to come, which of course nobody knows. We all may want to speculate on that, but nobody knows it at the time. And so when we trade our VolContracts, we're going to be trading at a price that's going to reflect what has already taken place and what is history, but what remains to take place in terms of realized volatility from today until expiration date. And so you're getting a contract that's going to have the flexibility of delivering realized volatility from day to day, and yet with that mystery of the component that says the story hasn't been completely told yet. There's more volatility to come, and we're going to see that reflected in the price of the contract. The important part, of course, is that when settlement day or expiration day finally arrives, then the whole story is told. Then we've logged each one of the close-to-close data points. We've got the returns for 21 days or 22, whatever the trading period may be. If we're trading a 3-month contract, then perhaps we're out into 68 or 69 trading days. And the entire story is known. And we're going to settle to that calculated value. You can take it to the bank. It's a formula. We're not going to settle to sentiment. We're not going to settle to forecast. We're not going to settle to traders' guesses or estimates of what volatility may be. We're going to actually say the formula tells us that this was the volatility of the underlying asset for the period in question, and that's what will be delivered to the holder of the contract. These are cash-settled instruments. They have multipliers, much the way futures do. For our financial instruments, those multipliers will probably be $1,000. So if you bought at a particular level, let's say 20, and you were wanting to own the volatility of the Nasdaq for the month of March, and when settlement or expiration came along, we found that it was 22 on the calculation, then you made 2 points or $2,000 on that contract that you bought. So we think these are fairly simple to understand. We think they fill a need, a gap for delivering realized volatility to the seller or to the buyer, as opposed to the alternative, which is the implied volatility concept. And when we do come out with the Nasdaq contracts, we hope listeners will take a look and see if this may fit your needs, whether you're options traders, futures traders, speculators on market movement. There's a little something there to intrigue everybody.
Well, thanks for that rundown there, Don, and very timely indeed, because not only do we have our 1-year anniversary coming up, but you will be launching the Nasdaq contract sometime in the near future, and so I'm sure we'll be inundated with questions yet again about how do these contracts work, and an influx of new listeners wanting to know all about the Nasdaq products and how they're calculated. So this is a good refresher for our listeners, and a good primer for what is yet to come in the land of realized volatility. And with that, we're going to close out the old volatility viewpoint for this week and dive right into our volatility mailbag.
Listener mail. Listeners write in.
Mail's in.
Mailbox.
And welcome to the listener mailbag. This is, of course, the portion of the show where we give you the chance to talk back at us, you, the listener. And you can get to us a number of different ways via our forum on the optionsinsider.com. Just go to the optionsinsider.com, click on the forum tab at the top of the page, scroll on down to the Volatility Views listeners questions forum, and post away in there. Don is in there on a regular basis answering questions. He's much faster than I am at responding to your questions. So you'll probably hear from Don first before we even have a chance to get it on the air, because he's Don quick trigger Schlesinger over there. I like it. He'll answer your questions very quickly. Of course, you can also reach us via Twitter, twitter.com/options, twitter.com/volex_US. You can send us emails via our contact form. You can even send them over to good old Mark Sebastian, and he'll forward them on to us, and he'll be very pleased to do it. So a lot of different ways you can get in touch with us. You can also find us on Facebook, a number of different ways. And today's question comes in, a couple of questions actually. First one comes in from a user on our forum, goes by the handle Thomas, and he writes, "Guys, I love Vol Views. It's yet another great show on Mark's Options Insider Radio Network. Thanks for so much great content and so many great guests." Let me stop you right there, Thomas, and say thank you on behalf of all of us here. We're glad you appreciate all of the shows and all of the content that we send your way, particularly the guests here on Vol Views. There's a lot of work behind the scenes and wrangling all these guests, and we're glad you appreciate it. It's been quite the string of guests on this show, to say the least. And he goes on to write, "I know Mark has said several times in the past that the difference between retail options traders versus pro options traders is that retail trades direction while professionals trade volatility. I wonder if you guys can elaborate on that a little more, as I'm a little confused by the distinction. Do pros implement different strategies, different products? How do they trade volatility, and how does that differ from the way retail trades options? Thanks, and put me down for a one lot when the Nasdaq contracts launch. And I'm sure Don will hold you to that last part.
Yeah, we're going to hold him to that.
He'll be shooting you an email at a certain point saying, okay, you are now contractually obligated to trade a one lot. But
one lot traders unite.
All right, and what Thomas is talking about is something I've said a number of times on this show in the past and our other network shows as well. It's a very generalized distinction. Let me start there. In that typically what the retail type of traders typically focus on is the direction of the underlying. Hence, they're focused on delta. That's their main Greek. And they're putting on a lot of spreads that are fixated on the directional movement of the underlying verticals. They're trading a lot of maybe straddles, condors, things like that are traditionally, or a lot of downside put spreads, or they're hedging underlying with options. And most of it is primarily geared around the directional movement of the underlying. Whereas professionals, and that could be market makers, institutional traders, a number of different people fall under that professional title these days, and they tend to look at things a little bit differently. We look at volatility. In fact, I always call myself a volatility trader when I was on the floor as opposed to an options trader, because that was first and foremost what I always looked at. I never sat down and said, hey, what is my delta on this position? In fact, I always traded a strategy which was known as delta neutral, which meant I attempted to eliminate directional risk whenever possible. That was my way to try to capture quote unquote pure volatility, and that was the way we did it. So to answer your questions here, do pros implement different strategies? Yes, to a degree, they do. I mean, the retail are doing a lot of more directionally focused strategies like verticals and things like that, or pros are quite often doing things like risk reversals where they're trading skew tied to stock, or directional back spreads and directional time spreads where they're trading the volatility of one month against another. All of it usually delta neutral, all of it usually tied to stock, to really try to capture volatility on a more pure basis. Do they trade different products? Not really. The same products you do. They just take a dramatically different look at it than most retail does. And in terms of how does that differ from the way retail trades, well, we touched on that a lot in the past. And I should also clarify before I open it up to further comment here that this is a blatant generalization on my part, and there's a very large section of the retail audience, particularly those high-end active retail guys who are going over to someone like Mark Sebastian at Option Pit for mentoring, who are very actively trading the ways the pros would trade, the way they're trading, looking to scalp gamma, they're looking to trade pure delta neutral and capture volatility. So there is a growing segment of that retail audience that by all means is not a blanket characterization of all retail. But in general, that tends to be the way the ball shakes out. Would you agree, Mark and Don?
Yeah, I mean, well, I would generally, here's the one thing I would say is that retail traders that trade primarily direction are trading volatility whether they know it or not.
Yes, that there is a volatility component to everything you do in options. That's inescapable.
Everything you do in options. And market makers are actually trading directionally a little bit, even though they're primarily trading for volatility. So, I'm sure Don would agree with this. Volatility traders trade direction, and retail traders actually do trade volatility. If you don't understand the volatility component, you shouldn't be trading options, in my opinion, because you do have a volatility position. You sell an out-of-the-money put spread, or a credit spread as it's sometimes called. You're taking a short vol position. You buy a call because you think a stock is going up. You're taking a long vol position. So by understanding volatility, you can dramatically improve your ability to trade. The neat thing about options is that if you understand both components of the option, the directional bias and the volatility bias, you can win or not lose, even if you're wrong on one of your opinions. And I think Don would agree that if you are in the option game and you're trading a lot of options and you don't understand the volatility component, you are playing with fire and setting yourself up for paying a market maker a lot of money. Let's just put it that way.
And I agree with absolutely everything that both of you have said. I think a good way to summarize it, particularly the point that you just made, Mark, is that you rarely have positions where you say, I'm trading volatility and I don't care whatsoever where the market goes. and somebody else says, I'm trading the direction of the market, and so what happens to volatility, I couldn't care less. It's almost impossible to have those kinds of trades. However, that said, there are clearly positions that are established in such a manner such that changing volatility is the primary driver of the P&L of that position, and where actual market movement may take a secondary role or a less important one. And flipping to the other side, where we spoke about retail perhaps being more interested in directional type of trades, if you do something like a bull spread with calls and you buy a lower strike and sell a higher one, and you hope that the underlying will rise to the level of your short call, that clearly can have a day-to-day, mark-to-market component that responds to changes in volatility, but volatility is not the main driver, and it's not the main reason that you've done that trade. You've done that trade because you have a directional opinion that the underlying is going to move by expiration date of the options at least as high as the short call strike, if not higher still. So that's a position that's more dominated by the directional component and less so by volatility, particularly because you long one option and short the other, and volatility perhaps will offset to a certain degree. So I think the best answer to our listeners' question is everything that both Marks said, and then simply keeping in mind that when you fashion your position, you can do so such that either changes in volatility are the main driver to the P&L of the position, or changes in the direction, actual movement of the underlying is the main component in establishing whether you'll make or lose money. But clearly there's some overlapping, and it's rarely all of one and none of the other.
Well said, Mr. Schlesinger. All right, and next up on the old mailbag, we have a question coming in from Twitter by Chris X here, and he asks, Nasdaq or SPX, which has had the greatest vol of vol over the past few months? And Don, since I know you are always diving deep into the data section of the VolX website and always comparing these various metrics, including vol of vol on a regular basis, what have you pulled up here if we're looking at the different comparable vol of vols of those two indices over these very tumultuous past few months?
Well, I'll tell our listener where to find it, so that, you know, they always say, give a man a fish and you feed him for a day. Teach a man to fish and you feed him for a lifetime. So it's easy enough to just tell you what the answer is, but if I show you where to go and find it, then you can do that for, you know, the rest of your life going forward.
How biblical of you, sir.
If you go to volx.us, which is the website, and you simply, in the pull-down menu, go to data, you then have sub-menus, and one of them says the Volx indices. When you pull that up, you get all of the indices in currencies and equities and commodities and interest rates, and you get historical information going back 12 months, 3 months, and 1 month, both for historical volatility and the vol of vol, which is what the question's about, and kind of like a free bonus that we throw in, you get forecast vols as well, courtesy of Professor Robert Engel at the Volatility Institute at NYU. And those are in the form of 1 month, 3 month, and 12-month predictions of what future realized volatility will be. It's
how accurate has he been?
These are things that have to be looked at over long periods of time. So these are modified Garch forecasts. So, you know, you can take a look at actual lag graphs that we have in our charts. So I can also tell you, Mark, that the best way to look at that is to actually go to our drop-down charts, where you can get these lagged comparisons of the forecast volatility to the actual realized volatility, and you can just see the whole thing play out in chart form right in front of you. So that's a lot of fun to take a look at as well. But just to quickly, answer the vol question, here we have Nasdaq and here we have S&P on the equities charts, and recent 1 month vol for S&P is 106.5. Nasdaq's only about 82.4. So what it's telling you is that the S&P vol has actually moved around a little bit more violently than the Nasdaq. Going back 3 months, the numbers settled down considerably for 3-month volatility. And it's about 38 for the S&P and about 33.5 for the Nasdaq. Again, if you'd like to know how all of this compares to what that type of volatility usually is, well, then you go to something like a Nasdaq chart and you bring up the historical volatility and the vol, and you ask it to go back for as much data as we possibly have, and you look at historical norms. You find that for 1 month volatility of Nasdaq, we're just about where we should be. The long-term volatility of volatility for 1 month Nasdaq is about 85.3. That's exactly where we are right now. So we're kind of in the ballpark. For 3-month volatility, it's 28.4. So about 5 points over what long-term historical averages are. So in terms of vol, or how much it's moving around, we're pretty close to what the norm may be. In terms of the actual volatility itself and the level of volatility, we mentioned earlier that we are very, very low. Long-term 1 month volatility for Nasdaq is just a drop over 25. 3-month vol, about 25.7, very similar. So when you're looking at levels that are 10, 11, you are looking right now at realized volatility, which is historically very, very low for the equity indices.
All right, Don, thank you for that very biblical interpretation of the vol question here. Very good stuff. Listeners, of course, we always encourage you to surf on over to volex.us and check out that information for yourself. You can find it on the data section there in the left navigation menu. And now we're going to close up the mailbag for this week and dive right into our crystal ball segment.
And now we take a look at the crystal ball.
Those mysterious and somewhat calming tones. It's a good way to end the show. Kind of brings us down a little bit, calms our listeners down. Time to get ready to close out the show here. And of course, in the crystal ball, this is where we dive deep into the murky ether of the future and attempt to determine what the land of volatility has in store for us over the coming week. And Mark, you weren't here for us for most of the vol review here, but Don and I were chatting about the continued discrepancy between VIX futures and the VIX cash and how that will play out going forward. Obviously, they have to settle out somewhere, and we were discussing whether the old VIX cash will kind of bubble or froth north to meet the futures, or if the futures will somehow drift ever south to somehow meet, or maybe the two will kind of, both will happen and they will kind of meet in between at, let's say, the 18.5 level.
I don't think there's any way the future settles above 19. And, I mean, unless we get some sort of crazy thing going on. But, yeah, I mean, there's no market movement. There hasn't been for 2 months. I'm not sure how, and VIX itself is finally starting to kind of take that realization as it's now below 17 as we look at it. And will likely threaten 16 next week if we keep this up. So with VIX futures trading at a 5-point premium, almost a 33% premium, there's no way they can hold. There is sometime in the next 2 weeks probably there is going to be a major sell-off in the VIX futures, and it's certainly in March. So there, some interesting future strategies that might make some sense to trade that, where you could try and kind of isolate the Vega, but it certainly looks really screwy to me right now.
You think it'll be as precipitous as the downward move we've seen in the VIX cash, where it's kind of just been endlessly straight down?
Oh, I think so. I mean, I think you're going to, over the course of a couple of days, you'll see the futures drop 3 or 4 handles. It needs to happen.
Should make for yet another great and highly contentious VIX settlement. It'll be a fun one this month too, I'm sure, and a lot of people will be writing into the show saying, how could it possibly have settled at X? And I look forward to your emails on that subject.
Well, it's not like anybody ever messes around with the settlement.
No, of course not.
Never happens.
And listeners, if you want to know more about that, of course, check out the episode we just did a few weeks ago with Henry Schwartz at Trade Alert, all about VIX and whether or not it can indeed be manipulated around settlement time.
Boy, Henry Schwartz. I love that guy.
You do have a lot of man crushes, sir. I will say that about you.
Well, he's a nice guy. He's smart. He's got a good service. So...
Yes, I recommend everyone check out his service if you haven't already at Trade Alert and also at whatstrading.com. And speaking of the land of equity vol, Don and I were diving deep into the land of Nasdaq vol on the old Volatility Review. And Don, we talked a little bit about it in the Vol Review, a little bit again in the mailbag, but we're kind of in this range now for Nasdaq, kind of the appropriate range if you look at the old Vol cones. So do you think we hover around here for a while, or do we kind of take a VIX turn to the south sometime in the near term, a very precipitous turn to the south yet again, or what do you think?
Well, of course, our difference here is that we don't have the corresponding volatility product. And so, we'd like to take a look at a product that's trading Nasdaq volatility, and that's what we're obviously hoping to bring out shortly. So lacking that and looking at the cash volatility and speculating on where it might go, these are, again, historically extremely low levels. And it's one thing to say that a volatility futures contract is trading at a 5-point premium and we don't think it's sustainable. That doesn't necessarily make a comment on where the cash or the underlying will go. So if I have to comment on that for Nasdaq, I would have to forecast going forward that it's unlikely that realized volatility will go a heck of a lot lower than the levels that I'm seeing now. And as I'm saying this, I'm just pulling up those VLab or Vol Institute forecasts of Professor Engels. He's actually forecasting 1 month going forward, and this is for actual volatility, 15.35 for the Nasdaq. I can't say that surprises me. So if we have to make a forecast going forward for actual spot volatility, I would have to say it's tough to consider going too much lower on the actual volatility.
Yeah, it's kind of hard to argue with Robert Engel on that one. But of course, you make a good point, and it is interesting maybe to further discuss going on down the road here about how Nasdaq vol, I suppose you can call it still to this day pure vol, at least maybe until you guys list your instruments. But the SPX vol is not really its own beast anymore. It has all these other components. It has VIX products trading off of it and all of the inherent paper flow that goes on there. As we saw earlier, the ETNs and ETFs and their inherent paper flow and how they impact in turn the VIX and other things. There's a lot of S&P vol now has many masters along with not just the underlying movement anymore. So it's interesting to see how that kind of plays back into the overall volatility levels. And I'm sure once we start adding more and more volatility products on NASDAQ, we'll start seeing a similar pattern unfold with the volatility in that index as well.
I can only hope that we'll have the kind of volume in these products that will make that happen.
Don, you guys are going to be moving NASDAQ vol every day with your products and the hedging.
I'll be interested that'll be really interesting to watch trade. So I'm kind of interested in how that thing moves around.
I'm certainly looking forward to it. Yeah, and all the various things that list off of it and all the other fun ecosystem that builds up around it. And of course, last but not least,
Don, maybe someday, in my dream, we're talking about what's the NASDAQ symbol going to be? Any idea? It just up if you don't know.
No, I don't know.
All right, so let's make one up.
NQQ.
Well, it's NASDAQ realized vol. So let's call it
NRV,
let's call it VNR, volatility of the Nasdaq realized. So Mark and I will be talking about T-VIX and how the creation units have been shut down, and how it's trading at a huge premium to NAV because of that. That's my dream for the T-VIX.
And Don will no longer be on the program, of course, because he'll be on his private island in the Bahamas.
He will be you and I will be doing the program from his island.
Oh yes, that's true. We'll have a studio on Don's island.
Don already promised me that if an ETN based on their product gets topped out into the amount of creation units they can make, he's going to give each of us $15 million.
I like it. I will hold him to that, and we can all live happily on the Isle of Sold to you.
Exactly.
All right, Don, and before we wrap it up here, we talked about the euro obviously going forward. Seems like the euro, most of the unknowns have kind of played themselves out. We're kind of in a holding pattern with the euro. So you think we're pretty much going to be hovering around these levels next week for the euro as well?
Yes, I'd have to say here I can't take a great stand in either direction. We settled at 9.38 last night. The forecast vol for the actual expiration of this contract, which takes place 2 weeks from today, is 9.36, so practically the same number. The realized portion is in the upper eights. The part that's left, the mystery, if you will, is in the lower tens. Everything seems to be converging to the mid nines and looks pretty correctly priced at this particular time. I wouldn't go out of my way to take any type of big position one way or the other.
Yeah, not until we hear of the next country imploding out there, and then the whole cycle begins yet again.
That's true.
All right, and that is going to do it for the Crystal Ball segment. That's also going to do it for this episode of Volatility Views. I, of course, want to thank my two partners in crime here for joining me on the show today. And starting off with you, Mr. Slinky, a.k.a. Mr. Seabass, a.k.a. Mark Sebastian of OptionPit.com. What is coming up over at Option Pit that may interest and or intrigue and perhaps even titillate our listeners?
Well, the interesting thing we have going on, obviously, read the free blog every day, optionpit.com/blog. Our next gold cycle, which is our kind of, a really good trader education, starts March 1st. Go to our website to sign up. March 24th, in conjunction with thestreet.com, I will be doing a all-day educational seminar on trading the S&P 500. So we're going to go through everything from futures to spiders to options on SPX, SPXPM, ES options, spider options. We're going to go through the whole complex of the S&P 500. Should be really, really interesting. If you have interest in that, you can email me, mark@optionpit.com, for information, and we'll set you up.
Good stuff. As always, listeners, I encourage you to surf on over to optionpit.com and check out all of the happenings that Mark and Andrew have going on over there. And then also, Don, what is coming up over in the land of volex.us? I know you guys are working furiously to get the Nasdaq situation settled, but is anything else going on of interest up on the old website?
Last week I mentioned the Volatility Library, and we're really proud of this reference tool. The other day, in conjunction with getting ready for the launch of the Nasdaq Volatility Futures, the VolContracts, we had many questions about how they would be priced. And we've mentioned more than once that VolContracts are extremely similar in nature to the over-the-counter product, which is known as a vol swap. And they use the same formula in order to calculate that realized volatility. So I did a little digging on the internet for articles by academics and scholarly articles that would explain some of the ins and out of vol swap pricing. In those types of papers, you often get variance swap pricing that sort of comes along for the ride, and you get two for the price of one. But I cataloged at least 9 or 10 very fascinating and well-written papers on the subject. So as a surrogate for a paper that hasn't been written yet, since there hasn't been the product, VolContract pricing and how it will work, you might take a look at vol swap pricing and how that works for those who are interested in the mathematics. And we're in the process of getting all of these papers that I kind of assembled and putting them into our reference section of the volatility library. So listeners can take a look at that. Only other reminder is of our friends at the London Financial Studies Group and their upcoming workshop on trading and managing risk, a volatility workshop that's going to be offered in New York City, May the 14th through the 16th. You can go to our website for information and the full syllabus of the 3-day program. Those who are interested in studying volatility and who may find themselves in the New York City area in the middle of May, it's a lovely time of the year here and might be a good time for you to look into that.
Great. Thank you for that, Don. And of course, if you want to submit your questions or comments for the show or check out any of the information we discussed on the show in more detail or check out any of the other content we have, including a number of other programs on the ever-expanding Options Insider Radio Network, then by all means, surf on over to theoptionsinsider.com. I think you'll like what you find there. And that is going to do it for this episode. I, of course, want to thank everyone out there for downloading and streaming and subscribing to this program and supporting it over the course of nearly a year now. It's been a fantastic ride. And we'll see you next week right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about VolContracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.